Forget traditional automakers. Ferrari is not a car company, it is the ultimate luxury asset. Welcome back to the channel for our April 2026 portfolio update. Today, we are taking a joyride with ticker RACE, traded on the New York Stock Exchange. Let us start with the company overview. Ferrari is a global luxury icon, dominating the high-performance sports car market. They operate through exclusive automotive manufacturing, Scuderia Ferrari Racing, and premium lifestyle merchandising. Their V8, V12, and hybrid innovations command massive pricing power, and their order book is still completely sold out. Now, let us look at the numbers, starting with a breakdown with their business segments. Their shipments are carefully distributed across global markets like Europe, the Americas, and mainland China to ensure no single economy can heavily impact their bottom line. The stock chart has been an absolute beauty for long-term holders. Revenue is approaching that $8 billion mark, driven heavily by their personalization program, where clients pay hundreds of thousands of dollars just for custom paint and stitching. Moving down the income statements, here is a look at their net income and the free cash flow they generate. The profits are consistently trending upward, and that free cash flow is critical. It means Ferrari funds its own growth and dividend without needing to constantly issue new shares and dilute your investment. You need to pay very close attention to this next metric, an operating margin of nearly 30%, alongside rapidly growing earnings per share. A standard car company like Ford or General Motors struggles to hit 5 to 8% margins. Ferrari's 30% margin proves they are selling a Veblen good, a luxury status symbol. But because of those elite margins, the PE ratio is very high, sitting around 34. The market forces you to pay a massive premium to own this level of quality. We also have their dividends, which is a tiny 1% yield, so you are buying this for capital appreciation, not passive income. Long-term debt sits at a very manageable $3.2 billion, so nothing to worry about here. Let us transition to their competitive advantages. Why does Wall Street love this stock so much? First, they have a multi-year backlog. While other car brands panic during a recession and drop their prices to clear inventory, Ferrari's sold-out order book means they have guaranteed, predictable revenue locked in for years. Second, they possess an elite brand moat, providing unmatched pricing power. When supply chain costs or inflation go up, Ferrari simply raises the price of their vehicles, and their wealthy clients do not even blink. Third, their first-one heritage represents the absolute peak of performance and innovation. The millions they spend on racing technology directly trickles down to their consumer street cars, keeping them far ahead of the competition. Now, let us look at the analyst ratings and the core weaknesses of the stock. 81% of Wall Street's analysts rate this a buy, but we need to look at the bear case. The biggest risk for investors right now is the extreme valuation. At over 30 times earnings, the stock is priced for absolute perfection. If they miss earnings estimates or if margins drop even slightly, that multiple could compress violently. Another structural issue is the capped volume. To maintain their luxury status and exclusivity, Ferrari purposely restricts production. But that strict limit means they cannot simply double their manufacturing output to grow revenue. They have to rely on raising prices. Finally, the EV transition and emissions regulations threaten their iconic V8 and V12 heritage. A huge part of the Ferrari appeal is the sound of the engine. Can they replicate that emotion in a purely electric vehicle? To wrap up with my personal thoughts, I proudly own ticker RACE and have zero intention of selling my shares anytime soon. While the high valuation multiple scares away traditional auto investors, the unmatched luxury brand moat makes it the ultimate recession-proof compounder. Please remember, this is not financial advice. Always do your own research before investing. Thanks for watching, like, share and subscribe for more deep dive stock analysis every week. And do not forget to comment below telling me which company I should analyze next.